Thank you for joining me today. I just returned from Dallas last night where we had an awesome event for the Collective Inner Circle. I did a presentation there, and then I did a presentation at the Real Estate Guys Goal Setting Seminar as well. So really just a fantastic weekend, except for one big thing. Help me understand how you can possibly live in a cold, cold climate. When I got up to walk the dog yesterday, it was 15 degrees, but wait, there's more. The feels like temperature, which includes the wind chill factor and the humidity, it was -1. And I had my down jacket, I had all the right warm clothes, and it was freezing. I mean, walking the dog, I felt like my eyeballs were going to freeze. How do you do that if you live in a cold climate? Give me a comment below and tell me how you do it, because I don't know. I'm glad to be back in Palm Beach, Florida, where I was sitting at the coffee shop this morning and it was 73 degrees. So you folks with your cold climates, you're tougher than me, I tell you. Anyway, hey, I wanted to share with you one of the many, many things I presented over the last few days last week at both of the events, and that is about how all the experts got it wrong, because this is so critically important. It is so critically important that you understand this thing, and it'll just take a moment before we get to our guest today. So here it is. Look, when we saw these interest rates increase, they went to a multi-decade high. They went up so quickly, and everybody thought, how will anybody possibly afford a home with the lowest affordability in 4 decades? 40 years, housing affordability has never been this bad in 40 years, since the early 80s. Young people obviously can't afford a home. That's the cry we heard over and over again about how will society move forward if young people cannot afford to buy homes. And the experts, they just got it wrong, because they had the wrong context. And context is so important for everything in life, everything we do, everything we think about. It's all about the context, more important than the content. So what does that mean? Well, you saw me show this before, but I've modified this chart just a little bit to show it to you, because since we saw these massive interest rate hikes, only about 5 million transactions have occurred. And those people accepted much less affordability than the prior people who had already purchased or refinanced their home or have no mortgages at all, right? Those people account for the bulk of the issue, right? So here we look at this chart and we say, yikes, this is terrible. Affordability is so low. Nobody will ever buy a house. The market's going to crash. Lots of inventory is going to flood the market. We're going to have an oversupply of properties. But we didn't have that at all, because this was only 5 million people. It was only 5 million. It wasn't a big deal in the overall scheme of things. Remember, 25% of the country approximately has a mortgage at or below 3%, 65% of the country at or below 4%, and 42% of the country no mortgage at all, free and clear. So no distress, very, very comfortable people. And that accounts for about 135 million properties, compared to only about 5 million that had transacted during the lower affordability era since we saw the interest rate hikes. So the biggest amount of properties, the lion's share of the properties, represents people who are extremely comfortable in their mortgages. They have a very high rate of affordability versus this small number, only about 5 million, with a much lower rate of affordability. No problem for them. They're extremely comfortable. They have no concerns about affordability. In fact, I shared with you before about how literally if they became unemployed, they would quite literally qualify on a debt to income ratio with unemployment insurance, not with their regular jobs. They would qualify for the mortgages they already have. And remember, 42% of those people have no mortgages at all. So this is the important thing to look at. I just can't stress this enough, because this is where all of the so-called experts got it wrong. They just completely missed the mark. But your humble host, yours truly, I got it right. And I understood this. And I shared this with you before in many different permutations and iterations. And this is why it's so important. During my first presentation in Dallas, they said, well, Jason, prices are set at the margins. And I'm like, what the f does that mean? Look, I'm an economist. I understand diminishing marginal returns. I get it, right? I understand all of those economic concepts. But the fact is, when people get wonky and they try to talk about things like the yield curve, and they try to talk about this, that, and the other thing, all of these 135 million mortgages, or properties, I should say, because 42% have no mortgage at all, they don't care about the yield curve. They don't care about prices set at the margin. They don't care about any of these wonky concepts. They only care about the fact that they are extremely comfortable, that they either have a super low mortgage rate and thus a super low mortgage payment. In fact, their mortgage payment is $18 cheaper in nominal dollars than the typical mortgage payment was 10 years earlier. 10 years earlier, the mortgage payment was literally higher than it is for these 135 million properties, right? It's absolutely astonishing. And again, 42% have no mortgage at all. So that's all they care about. They don't care about any wonky economic concepts. All they care about is the fact that they are extremely comfortable and they are not giving up the incredible deal they have. They are not selling their house. And that's why we only have 499,000 homes for sale in the United States. Inventory, compared to about 140 million housing units, only less than 500,000 of them are for sale. That's some of the lowest inventory we've seen ever in history. Yes, it got a little lower during the crazy pandemic era, down to about 240,000. But again, that represents about a 700,000 home shortage of inventory. So again, I know I've repeated some of this stuff on prior episodes, on prior videos, on prior podcast episodes, but this is what is so critically important to understand. The overall context of the market shows us why we have continuing appreciation in a market where we have seen the cost of money triple and prices have still appreciated. Literally, the most resilient asset class in world history is income property, residential real estate, single family homes. These are the coveted properties that everybody wants, and we have a massive undersupply of these properties. In fact, one of the things I shared in my presentation, we've heard these numbers bandied about. Oh, we've got, 5 million houses short. We need to build 5 million homes to get to a normal supply ratio. We need to build 3.8 million new homes to have enough supply. Well, I shared an article that made the case that we need over 7 million homes built to make the market balanced, right? So, whatever that number is, look, the fact is we have what we have, and we have an incredible shortage of housing. And if you are an investor, you want to have assets that are scarce, that are in demand. And that's why you want to increase the size of your portfolio. And if you want to learn how to do this, and you want to learn how to do this properly, be sure you register for our Empowered Investor Cruise coming up. We're going to have last call on this very soon. So that is coming up. Go to empoweredinvestorlive.com and get your tickets for our 5-day investor cruise coming up. This cruise is such a bargain. I mean, it really is such a bargain. You get to mastermind with all the right people for 5 days. You get to have fun. You get to be on vacation. So go to empoweredinvestorlive.com and join us for our upcoming cruise.